Another week, another consumer discretionary giant issuing major warnings on the current state of the economy and how weak many consumers are. Target just reported earnings, seeing shares tumble after missing Wall Street estimates, and their CEO, Brian Cornell, told reporters that high prices are hurting the wallets of customers. And Target's Chief Growth Officer, Christina Hennington, also said, "We remain cautious in our near-term growth outlook." She added that the sustained level of elevated prices has had a meaningful impact on budgets and savings for many families, and that currently 1 in 3 Americans has maxed out or is nearing the limit on at least one of their credit cards, which is a truly alarming statistic. And looking ahead, she also did say, "We expect discretionary trends will continue to remain pressured in the short term." This follows suit with insights given by Walmart on their earnings call a couple of weeks ago, with the company noting that high-income customers were trading down to Walmart, which helped to drive sales in its grocery business. And Walmart's CFO, John Rainey, made it clear that with prices soaring, consumers have been prioritizing staples over larger discretionary purchases, which has benefited Walmart's grocery business, but has been damaging to their general merchandise segments, as well as competitors like Target and Home Depot. Walmart's disclosure a couple of weeks ago and Target's announcement this week of price reductions on everyday items are direct responses to consumer fatigue after 3 years of high inflation. McDonald's is another consumer discretionary giant who have recently come out with a concerning outlook on the state of the US consumer, with the CEO warning that consumers continue to be even more discriminating with every dollar that they spend as they face elevated prices in their day-to-day spending. McDonald's and many other fast food prices have surged like everything else over the last few years, as the impact of inflation has caused the cost of ingredients and packaging to rise significantly. Prices of a meal have now reached heights of $18 in some states, something that would have been truly unimaginable several years ago. However, McDonald's have acknowledged and admitted that many consumers are pretty much broke right now and can no longer afford these prices anymore, which has led to McDonald's now planning to introduce a $5 meal, according to Bloomberg. Now, we know that rampant inflation and asset price inflation has led to everything going up in price. However, lackluster wage growth has also played a part in why many consumers are feeling so weak right now. And this chart shows annual real hourly wage growth across the different wage distributions, and it compares the time period of 2017 to 2020 against the time period of 2021 to 2023. And as you can see, between 2021 and 2023, every level of income besides the bottom 10% have seen negative real wage growth, while workers at every level of income have experienced worse income growth between 2021 and 2023 compared to between 2017 and 2020. So not only are US workers seeing their real income growth get worse in recent years compared to in the past, but in 90% of all cases, unless you are the bottom 10%, you have actually seen a negative real wage growth, which means that most people are now worse off compared to what they were in 2020, even if they have experienced a pay rise. It's therefore no surprise that a lot of people are struggling financially at the moment, and in almost all cases feel poorer than what they were a few years ago. And in many cases, people are being forced to turn to credit cards to afford even day-to-day essentials like groceries, and we have seen credit card debt surge in recent years, while simultaneously the personal savings rate has declined to being close to all-time lows. And these credit card balances are punishing those in debt more than ever before, as the average interest rate on credit cards today is the highest it has been throughout history. So those who are sitting on a lot of credit card debt are being drowned out more than what is historically normal by these monthly payments. And this graphic by Visual Capitalist does show the household income that is needed across all of the US states for 2 working adults and 2 children to maintain a comfortable lifestyle. Now, a comfortable lifestyle is defined here as the income that is needed to cover a 50-30-20 budget, with 50% allocated to necessities, 30% to discretionary spending, and 20% to savings and investments. Looking at these figures, we can see that the most expensive states are in the high 200,000, close to 300,000 range, with the vast majority of all states being above $200,000. Now, it is interesting to look at these figures that are needed for a comfortable lifestyle across the different states. However, it does become quite concerning when we take a look at what a normal family household income actually looks like for the average household. The median family household income across all of the US is about $93,000, which is a long way off the sort of family income that is needed nowadays to live a comfortable life. Even to live in Mississippi, which is the cheapest state on this list, you do need $178,000 in family income to live comfortably, a figure that is close to double the national median of $93,000. Now, granted, there is an argument to be made here that the 20% being allocated to savings and investments could be removed from the definition of comfortable, but even shaving 20% off all of these state figures, it still means that you need to be earning far higher than what the median family household income is to be comfortable. And this really does show just how big the gulf has become between wages and the cost of living, and the fact that many households are now living close to the breadline because of how much the cost of living has risen compared to what they are earning at their job. To make matters worse, on top of this, the pain that many are feeling from the cost of housing is not going to disappear anytime soon either, and it's becoming increasingly difficult for those who are stuck renting to get onto the property ladder. The gap between average income and the average home price has never been larger, perfectly illustrated on this great chart from Visual Capitalist that shows that today's median home sales price of $433,100 is a whopping 5.8 times the median household income of $74,600. Now, this price to income ratio of 5.8 is a lot higher than what it was in 1985 when it was just 3.5, making it far harder for young people or anyone who wants to buy their first home to actually scrape together enough money for a deposit to buy a home. The ratio has been growing gradually over time, but it has ballooned in recent years thanks to a surge in almost all asset prices, which of course also includes homes, partially due to how much money and liquidity was pumped into the economy during the pandemic to stimulate the economy. But stubbornly high mortgage rates that are still in and around the 7% region have made housing affordability a nightmare for many homeowners, and the national payment to income ratio for a median priced home on a median income now sits at 36.1%, exceeding the peak that was seen during the global financial crisis of 33.9%. And with inflation still being quite stubborn and not yet falling below the 3% barrier, many economists fear that rates are not going to be reduced anytime soon and are going to stay higher for longer. So not only has it never been more difficult to get onto the property ladder, but it has also not been this expensive for homeowners to keep up their monthly payments since the 1980s. And in fact, a consumer insight survey by Statista shows that 52% of people do worry about inflation and the cost of living, making it the thing that people are worried about the most. In third place at 40% is people being worried about the broader economic situation in the US, and poverty and housing also comes in at 5th and 6th on this list. On the whole, economic issues are now a bigger concern for US citizens compared to a few years ago in 2019 and 2020, which shows that many people have seen their financial situation get worse over the last 5 years or so, and there is far more financial pressure on people in general. Now, unfortunately, this deteriorating economic situation is not just limited to consumer weakness, and in fact, major institutions and financial figures like Jamie Dimon and Ray Dalio are warning that complete economic collapse is on the cards. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.